Good morning to everyone and welcome to the fourth in our series of Sandyford Business District webinars in our COVID-19 series. Our webinars have covered working from home, a detailed HR session and maintaining your health and well-being. But today we're returning to a theme that we had early on, tax and financial supports for business. We've had a huge amount of interest in this topic and a lot of questions and follow-ups, and there have been a number of developments that we hope to cover today. The previous webinars are available to you view back on our website now if you've missed them. We're looking forward to an interactive session with the opportunity for you to ask our panelists your questions. Don't worry about taking notes. We'll be posting the webinar presentation on our COVID-19 hub on the Sandyford Business District website. We'll work to a 50-minute timetable this morning with your questions featuring prominently. With a government plan to exit the lockdown now in place, business will be looking at ways to finance their working capital requirements. In addition, the temporary wage subsidy scheme has developed and will form an important part of business returning to a more normal operation. I'm Mark Lowry, Director of Sandyford Business District, and I'll be your host for today's webinar. It's great to see so many of you log on and attend our webinars. But we'll be taking your questions, so please post them during the event using the question tool at the bottom of the screen, and we'll address them as best we can during the webinar. As always, where you have a particular concern or issue, please talk to the Sandyford Business District team, and you can also contact our participants. First up this morning, we have Conor Battigan, CEO of Sandyford Business District, for an update on our activities and initiatives. Good morning, Conor.
Yeah, good morning, Mark. How are you?
I'm very well, and I'm sort of getting used to working from home at last. How about yourself?
Yeah, look, it's a challenge. I've mentioned before, I've done it before, but when I've done it previously, there hasn't been any kids, so it's the kids that make it challenging. So they don't understand that the dad, or with most families, that mum or dad or somebody is in the house, but they're not there to play, they're there to work. So it's more challenging for the kids.
Very good. I hope you've been getting your exercise in from our last webinar. Okay, so you might give us an overview of the business district and what's happening at the moment.
Yeah, so look, the district was a hive of activity pre-COVID-19, 26,000 employees, 1,000 companies, 4 business parks, Central Park, South County, Sandyford, Stillorgan. 5,000 residents, up to 4,000 visitors on a daily basis. Very diverse in terms of the companies that we have based in Sandyford. Motor tech, med tech, finance, you name it, it's there. But it's a bit of a ghost town. There was always people going about their day-to-day activities, on the ground. That's changed dramatically. Some businesses had to close down due to COVID-19 restrictions. Others have seen an uplift in business. The medtech sector is busy, very busy for obvious reasons. Includes Beacon Hospital, doctors, consultants, pharmacies, GPs. So it's changed dramatically, but I suppose it's business as usual for some businesses. It's business almost as usual for others. If you are a business and you're opening or you're operating as almost as usual, get in contact with us. We will promote you, on our website, sandyford.ie, or our social channels. If you're a business that is, offering supports to businesses within various different sectors, for example, Bibby Financial Services, they offer financial support to SMEs. So if you're one of those businesses, please get in contact with us. Excuse me, and we'll promote what you're doing on our social channels and also on our website.
So Bibby have a series of supports in terms of working capital supports that are available there, and we'll publish them up on our website. And thanks to Bibby for sending those through. And if there are other financial institutions in the district with promotions or offers that you have at the moment, please send them through to us. Obviously on Monday, there's a change, and we're into phase 1 of the opening up government process. So what's going to happen in Sandyford over the next couple of weeks?
Well, look, it's great to see. I suppose there's a roadmap, in terms of getting rebooting the country, the economy. So what we will do is we will run, a series of webinars addressing, the various issues that the phase reopening brings. So, for example, on the 18th of May, there's a number of hardware depots or outlets, DIY stores that will be reopening, which is great. And then following that, we'll be holding a webinar which will evolve around health and safety. So I suppose advising company owners and managers in terms of what's required, bringing staff back into work and what's best practice. So we'll be holding a webinar of the coming weeks to address that situation.
Yeah, and I think it's important to say that there's plenty of parking in the district for people who are coming to buy their much needed hardware and all that sort of stuff. Paint, I think, is the big one people will be looking for. But please be patient, because it will be busy, and we're going to try to make sure that there's social distancing is respected. So it'd be a good idea if people take their time, relax, and be patient.
Yeah, absolutely. Yeah, it's all about, I suppose, taking the common sense approach and following HSE guidelines. And while there are developments, be it financial supports, COVID-19 developments that the government announce over the coming weeks, we're staying on top of that. We're publishing those on our website, sandyford.ie. And if there's any need for clarification around supports or how to access those supports, we're asking those questions. We're asking government, and we're posting the updates and feedback from government on our website. So we're following HSE guidelines, and in terms of rebooting Sandyford.
Excellent. Thanks so much, Connor, and we look forward to seeing it being a lot more busy around Sandyford over the coming weeks and months. Now we're joined by our two expert contributors, Aileen Dunning, who's a tax expert from Smith & Williamson. And first up this morning, we have John Madigan, who is Head of Marketing and Research at the Strategic Banking Corporation of Ireland. So, John, what is the SBCI and what does it do?
Okay, well, the SBCI was set up about 5 years ago. It was actually one of the post-crisis initiatives by the Department of Finance to put in place an organisation that could act as a conduit for European funding into Ireland, and to try and address a couple of things. One, which is to bring down the price of borrowing for SMEs in Ireland. Two, is to bring more competition back into the marketplace, to bring more bodies back in that would actually provide lending to SMEs. And the third thing was to try and address the access to finance piece. And what that really related to was the idea that, SMEs were still being faced with the issue of having to give personal guarantees and security for their loans. And was there a way that we could actually, I suppose, interject in the marketplace and try and fix that one, particularly post-crisis? So we're set up to be counter-cyclical, so the idea was if things are going well, we should kind of step back out of the market, and if things go badly, we should be stepping back in. And I think the most recent emergence of COVID-19 has actually demonstrated the ideal, way that a national promotion institution can interact on and help SMEs in this kind of current crisis. So that's what we're here to do. So hopefully what I say today will be of use and assistance to most of the SMEs that are listening in. Mark, can you hear me?
Sorry, John. Sorry, John. We just had a dropout there. Accessing finance is going to be a key aspect of getting back to business. And you've prepared a few slides for us this morning, John. So maybe you just take us through the process and the things business owners need to do to access finance that's promoted by SBCI.
Okay, so maybe if we just get up the first couple there then, and we'll just, can we move the presentation on?
John, apologies. We seem to be having oh, here we go.
Here we go. Okay. All right. Well, look, I can actually put it up on the phone beside me anyway here if I need to. So, one of the first things that we were asked to do was to try and address the immediate needs that SMEs would have, which would be working capital to continue to pay bills for a period of time while they were either closed down, but to try and keep them viable, and by doing that was to actually try and give them sufficient scope by way of lending to get them through the initial 3-6 month period and get them then positioned to restart business as well. So the first thing we did was we actually took some of the funding that had been put aside for Brexit, and we redirected that to the COVID-19 working capital loan scheme, which was brought to market in a period of 2 weeks, which is pretty phenomenal, I suppose, in terms of being able to deliver something into the market pretty quickly. So if we move on to the next slide. So this is just a screen grab of the website, but it shows you on the bottom left the COVID-19 loan scheme, and just to click on that to find out more. So if we can just move on again. So the key features of the scheme. So we've gone down to loan amounts of 25,000 and up to 1.5 million per eligible client. The maximum interest rate is fixed at 4%, and that's generally what the three banks are offering at this minute in time. It's available through AIB, Bank of Ireland and Ulster. The loan terms range from 1 to 3 years, and that's simply because loan terms for working capital should be, you know, a maximum of kind of 3-year period. The loans are unsecured up to €500,000, and this goes back to the access to finance piece we discussed earlier, which was that, you know, if businesses were looking to borrow, they were being asked for personal guarantees and security. So for any loan under this scheme, up to €500,000, any one of the three banks cannot ask for security. Now, it is a loan and it has to be repaid, so therefore you will have to demonstrate repayment capacity to the bank that you're applying to, but it does actually put you in a position where the government is offering the bank an 80% guarantee for the loan that they're giving you, and they are on the hook for the remaining 20%. The other thing is that optional interest-only repayments may be available at the start of the loan, and that has been agreed with the European Investment Fund. So the bank can effectively do capital and interest roll-up for the first 3 months of the loan. So what it means is that if you understand your borrowing needs for the next 3 months, effectively you can borrow sufficient funding to pay those debts over the next couple of months, but not actually have to make repayments on the loan until that 3-month capital and interest repayment moratorium expires. And then obviously the loan and term is dependent on the loan purpose. So if we move on. So what can the loans be used for? So future working capital requirements. So that's, you're looking at the business you closed, your business has changed. Therefore, you're looking at, well, what do I need for the next couple of months to keep me in business and they actually allow me to come out of this at the other side. Now, the next piece here is to fund innovation, change or adaptation of the business to mitigate the impact of COVID-19. And we have had a huge number of queries on this because a huge number of businesses do not see themselves as innovative or actually investing in R&D. And then they're finding it quite difficult to find the innovation criterion on the application form that actually works for them. So what I want to say to everybody on the call this morning is the definition of innovation is really broad, and it includes any change to process, to people, to marketing, to sales that you need to make in order for your business to remain viable and to emerge from the crisis in a somewhat intact format. So What we're suggesting to people at the moment is that when you look at the form, there are a lot of innovation criteria. Focus on an innovation criteria number 1, which says that I'm going to spend 80% or more of the funding on R&D, innovation, or changing or adapting my business to face the challenge of COVID-19. So what I'm suggesting to people is that given the breadth of definition of innovation and given the breadth of impact of COVID-19 on many businesses, they will need to make a change of some description, even if it is to do social distancing in your premises. That constitutes a change and constitutes innovation for this particular scheme. So don't be put off by the fact that it sounds very wordy and very high level and it's all about R&D and tech. It's not. This applies to your local coffee shop as much as it does to your high-tech innovation company. So I really wanted to get that point across because that's a really important one for people.
Yeah, and just to reiterate that, John, I think it's this idea of innovation. You don't have to be a high-tech firm. You don't have to be somebody who's developing apps. This can be as simple as my sales team have to work from home, and therefore I need to adapt what we are doing and invest in that.
Exactly. So any change that you need to make is deemed to be innovative. All right, and that's really important, a really important message I want to get across this morning. Then obviously there are things that loans can't be used for, and one of those is refinancing of undertakings in financial difficulties. Now, that is, if you were to look at a date, that if you were in financial difficulties at the 30th of December, then 2019, then you couldn't use the COVID-19 scheme. If, however, your business is in financial difficulty since then because of COVID-19, then you can apply for the COVID-19 loan. All right. And then the other thing that is always excluded from European funds is the refinance of existing debt, term loans, leases, and hire purchase that existed prior to the COVID-19 scheme coming into play.
You could just maybe just stick to that point for 1 second, John, because this is one issue that I think people don't maybe appreciate, is that if when you go, you'll get maybe approval from yourselves and then you go to the bank and it looks like there's refinancing involved in this, your loan application may be rejected.
It may be, yeah, absolutely, because if you're effectively looking to refinance a debt at a cheaper rate, there's no additionality, and the European Union and the EU Commission and the EIB and EIF are very strict in terms of additionality, that any scheme they bring to market must include some additionality and not just actually distorting the marketplace.
So this slide is a key slide.
I do think that it's a key slide, yeah. But I do think as things move on, there is a new credit guarantee scheme coming, which is a 2 billion fund, which is huge. That's being worked on at the minute. There will be some level of refinancing available within that scheme. And there's an extension to the Future Growth Loan Scheme coming, and there may be some refinancing within that, but the refinancing within the schemes is likely to be refinancing debt that has been built up in this period of time. So say from January until, if we exit this in June, July or August, it will be the refinancing of that debt to allow the business to remain viable. Okay?
Thank you.
So just then in terms of who can apply, viable, micro, small and sub SMEs effectively. And the SME criteria basically is 249 employees maximum, 50 million turnover or 43 million balance sheet. That's the effectively the criterion, but it has been extended to include small mid caps, and small mid caps, the only difference there is that their employee numbers go up from 249 to 499. So that just gives a bit of clarity regarding the scale of companies that can apply for this support. The other thing just to bear in mind as well is that we've had queries from companies who last year had 800 people employed and this year have 200 people employed as of today, and are asking can they apply, and the answer is no actually, because the figure that the EIF again used for this is the figures at the last reporting period, which is generally at the end of last year. So it's just to be aware of those little difficulties within the scheme, things that will probably change over time, but as it stands at this minute in time, that's what's in there. And then who can't apply, it's usually it's primary agriculture, which hopefully won't apply too much in Sandyford. I think it's a long time since there's been too many farms up around there. And aquaculture probably doesn't apply either. Financial difficulties we already excluded, and then bankrupts are being wound up. So if we can maybe pop on to the next. So the application process, two parts to it. One part, I will say without any doubt, is very straightforward and very simple. Second part is not so straightforward. The first is to go onto the SBCI website to assess if your business is likely to meet the eligibility criteria. And let's be honest, if your business has been impacted, you know, your PBT, your profit before tax, or your turnover has been negatively impacted by COVID, then you qualify under that criterion. If you're going to make changes to your business under any description, then you will meet the innovation criterion. So therefore, it's relatively straightforward. But having said that, will I just emphasize to people, we need this form signed. So you need to print it off, and then you need to scan it back and email it to us. And there's an email application at the address at the end of the application form. And it's amazing the number of people who actually send the application form into the info email rather than to the dedicated scheme email. And that just delays things. We will assess the application, the eligibility application, and we are coming back to people now in less than 48 hours with your eligibility code. What you then do is you take your eligibility code. You will also need to do your business plan. People always, their eyes glaze over when they hear about business plans, but the reality is we have a very simple business plan for this scheme on the website. But I think it's really valuable that you engage with your advisor in advance of going into your bank at this minute in time, because there is so much uncertainty around cash flows in particular. What are you going to show to the bank? Are you going to show the bank that you're recovering in 3 months' time or 6 months' time? Or are you going to show that it's going to take longer for your business to become viable again and to be cash positive or cash generative? So your advisor will help you with that, because the more information you bring to the bank, the much better chance you have of the bank being in a position to say, okay, we have everything we need now to make the decision. And then that's the credit process, which I was just on a call with one of the representatives from Bank of Ireland earlier this morning, June Butler, head of business banking for SMEs. And she's saying, particularly for the smaller COVID scheme ones, that they are trying to get back to people within 48 hours as well. So we're trying to make this as simple and straightforward as possible, but it's not always going to be that way. And just to be aware of that. So for further information on the scheme, I'd say visit the website. There is a YouTube video which actually explains how you will apply for the scheme. So if you just want to have a look at that particular link, it takes about 2 minutes. It will carry you straight through the eligibility process from beginning to end. And literally there's guidance there on the website as well with regard to the business plan, what you need to fill out, how you need to complete. There's only 4 sections on it this time around, so it's pretty small, pretty compact. But again, I would say use the opportunity to run the business plan with your advisor, because it will actually help to bring about a quality application to the bank on your behalf and gives you a better chance of success. Okay. So just to give a sense around the scheme to date, we've had about just over 2,000 applications. We've issued just over 2,000 eligibility codes. So we've sanctioned over 200 loans, or sorry, the banks have sanctioned over 200 loans, and there's 33 million, or nearly 34 million of the scheme being allocated. Now that's of the initial 200 million. The scheme has since been extended by an initial 50 million, but now an additional 200 million, which will happen in the next couple of weeks. So there is plenty of capacity available in this scheme for SMEs to engage and to actually avail of a 3-year loan to get them over their cash flow issues for the next couple of months. So the other funding supports available. The existing credit guarantee scheme is in place, has been since 2012, but was revised in 2017. And And this covers facilities of 10 grand up to 1 million for terms of up to 7 years. So if you were looking for something that was longer term, if the impact on your cash flow didn't allow you to repay a loan over a 3-year period and you were looking for a longer period, AIB, Bank of Ireland and Ulster all operate this particular scheme, and it allows businesses to borrow for up to 7-year period. But the difference in this scheme is the bank can still ask for security on this one because this is an older type of scheme, and there isn't an amount in the scheme that is considered unsecured. But it is a very useful support, and it's been actively used, particularly by Bank of Ireland at this moment in time. The Brexit loan scheme is built exactly the same way as the credit guarantee scheme, or is built exactly the same as the COVID-19 scheme, I should say, with exactly the same terms and conditions. The other thing I wanted to say about the credit guarantee scheme is that there will be a new credit guarantee scheme in play, and it will take us probably a month or two to bring that into play. But this will be a huge scheme. It will be actually potentially 2 billion of capacity that will go in to help businesses. It's probably more in the restart mode when they're looking to actually set up and invest for a longer period of time and get their businesses changed and ready to restart. But we will have that in the marketplace, and it will be different to the existing credit guarantee scheme. There will be changes in there, none of which I can talk about at this minute in time, but it will be a more attractive scheme. And then the other thing to say is that the Future Growth Loan Scheme, the FGLS, which was a huge success, we put out a 300 million scheme, all of which was utilised within 6 months of being launched. It was a long-term scheme, 8 to 10 years, and that was at rates of between 3.5% and 4.5%. And again, interest with an amount of up to $500,000 unsecured on that particular scheme. That scheme will be extended, and that will probably come to market sometime in July. And there's an initial 200 million additional on that, and it may be extended further. So there will be a sequencing and a huge number of supports available to SMEs, particularly from the SBCI, but also just to remember that there are huge supports available from microfinance, which are offering, loans of up to 50,000 unsecured with a 6 months interest and capital holiday for schemes. So effectively what I'm saying is that, there's going to be plenty of funding available, but the important thing is that SMEs will have to be really clever about how they put together their business plans when they're making their credit application. So that's just a note there around the expansion of the two schemes. And as I say, the CGS is coming in the next while as well, which will be fundamentally a huge scheme of up to 2 billion euros. So I think that is about it.
Really good, John. I think there's a few questions I think that arise out of this. So the first one is, what you're saying is people not reading and filling out the forms correctly that are coming back to you. So it's important to reiterate: sign the form, scan it, and send it back into you. So that's the first thing.
Exactly, because it's I suppose.
Yeah. The second piece then is talking about the process. So I've got approval now from SBCI. I'm running down to the bank. What's your advice in terms of, should I be looking at a different bank? Should I be looking at the same bank that I bank with at the moment? What's the best process to follow here?
Yeah. I think in reality, what we've seen is that most banks are now actually saying to people, we're not taking on new customers. And that's anecdotal, but we're hearing that at the moment, because I think banks are actually trying to cope with their existing customers. So my strong view is that you should start with your own bank. But I would also say that if you do get turned down, I would automatically go into the appeals process. Ask them to appeal, ask an SME or ask the bank to appeal it, because there's actually a 1 in 4 chance, based on stats, that original decision could be overturned. And I would also strongly advocate that you, in the event that they uphold the decline decision and you believe that it's still a viable proposition, that you would refer to the credit review office, which are successful in about 50% of cases in getting the bank to come to a decision, which might not be necessarily everything you're looking for, but could actually materially improve your chances.
Very good. But I guess part of the reason there are rejections at the bank side is that the business case isn't robust enough.
Yes, absolutely. And I think, it's a lot of businesses are kind of just, are at the point where they're saying, well, I've closed now, so what do I say? But I think with advice from yourselves or from a, good advisor or accountant, you will actually be talking about, well, when you open, what's your business going to look like? Have you changed from being, sit down to takeaway? Have you space to put, tables and chairs outside if you're a small retail business? If you're manufacturing, can you put in social distancing? Do you work shifts? It's all those kind of things that actually will convince the bank that you understand exactly how you're going to emerge from this crisis, but emerge in a way that gradually will bring back viability.
Yeah, and I think this theme has come up before. Really, it is a good idea at this time to talk to an advisor. I think the other piece is that Enterprise Ireland, for Enterprise Ireland clients, have a scheme where they will fund an advisor for I think it's £5,000 to do a report on a business plan for you.
Absolutely, and even the local enterprise offices will do some free mentoring for you.
So there are resources. So Leo, EI.
There are resources,
excellent.
yeah.
And your local
microfinance,
your local accountant, and there is microfinance there. So one of the issues then is and this is one that I've heard is PGs. I'm being asked for a PG for the first $500,000. Is that true?
No, you can't be. And if you are, you just need to tell us. We'll just go back to the bank to clarify it. We've had a few, shall we say, I suppose uninformed, just frontline people who just literally have, been buried under the weight of there's about 5 different schemes coming. So, and the T's and C's tend to be a little bit off. But we've had one instance, I think, in the last, since we launched the first risk sharing scheme, where we've actually had to go back to the bank and they immediately withdrew the need for the personal guarantee. So for loans up to $500,000 under the COVID-19 scheme, under the Future Growth Loan Scheme, they cannot be asked for a personal guarantee for loans up to that amount. In excess of that, it can be. But for the credit guarantee scheme, they can currently be asked for a personal guarantee because there's no amount in there which is deemed to be an unsecured loan. But that may change in the new credit guarantee scheme.
Excellent. So really important stuff coming out there. Have a really good, robust business plan. If you can't produce that yourself, make sure to use an advisor. That'll help your process with the bank. Generally speaking, advisors have relationships with banks as well, and they'll be able to understand what the bank are looking for and the questions that may be asked around your business case. But ultimately, it's down to your business case.
Yeah, and I think, Mark, it's really important that people understand as well that a huge amount of borrowing in Ireland is less than 100 grand, particularly for SMEs. I mean, I think 90-something% of SME borrowing is less than 100 grand. So if you're looking for that type of money, you're quite likely to be dealing with a contact center. So the business plan is even more important in that case, because you're probably not going to get the opportunity to talk directly to your advisor, because that person is going to be somebody who is sitting in a contact center and who is totally reliant on the information that they receive from the SME to go with their loan application. So the business plan becomes even more important in that case.
Very good. Okay, so it's back to the Irish phrase of be Ullaf. Thank you so much,
Be
John.
Ullaf,
And just a reminder to post your key questions, which our panelists will address at the end. So now we're joined by Aileen Dunning, a tax expert with Smith & Williamson. Welcome, Aileen. So there have been a number of updates and changes to the temporary wage subsidy scheme, and there's some other tax considerations people need to bear in mind.
Absolutely. So thank you, Mark, and good morning, everyone. I'm really delighted to join you this morning to discuss some of the government supports under the tax umbrella. Today I have about 20 minutes to talk to you, and I want to use that time to focus on areas that will support your companies through this crisis. Therefore, the focus of the discussion is the very topical temporary wage subsidy scheme, where I'll summarise some of the key features and discuss the theme that exists now that we have moved into the operational phase. I will then discuss some topics that have been recently introduced, including the tax debt warehouse scheme, and share some practical tips that might help you achieve cash flow benefits. Next slide, please. The temporary wage subsidy scheme, commonly referred to as the TWSS, has been a welcome support for employers in these difficult times. Nearly 51,000 employers have registered with Revenue for the wage subsidy scheme, of which over 43,000 have received payments. The TWS payments, with a cumulative value of over 700 million, have been delivered to over 427,000 employees. The TWSS has been in operation since the 26th of March, but the operational phase only commenced on the 4th of May. Today, I'll recap on some of the areas that have changed and discuss some of the clarifications made by Revenue, identify and discuss some of the changes and the challenges arising from these changes, and draw your attention to some of the important elements of the scheme. There's been no changes announced to the employer eligibility criteria since the scheme was introduced. This is a welcome constant in this complex and evolving area. Revenue have, however, issued updated guidance on employer eligibility and supporting proofs. The updates include clarifications on a number of important matters, including that if a company is capable of separately identifying each business division and was capable of doing so before COVID-19, then the application of the 25% reduction in turnover or customer orders test can be applied to individual business divisions rather than to the company as a whole. It also goes on to clarify that for businesses, for the purposes of assessing the company's ability to pay normal wages, the examination of accumulated cash reserves where there's trade and non-trade activities should be completed at a company level. For an employee to be considered a specified employee for whom the temporary wage subsidy scheme can be claimed, it remains that they must have been on payroll on the 29th of February 2020. It is still the case that the claims for the TWSS cannot be backdated and that an employer must pay the full wage subsidy to the employee or they are not eligible to partake in the scheme. The calculation of the average net weekly pay has been an area that some funny outcomes have arisen. This is because it is based on the net pay delivered to employees according to the January and February payroll submissions, including bonuses, commissions, and other payments made during that period. Revenue have confirmed that if bonuses were paid in January or February, they should be included in the calculation. The good outcome of this can be that it increases the subsidy for people, but the bad outcome is where it pushes somebody into the 350 category, the €205 category, or indeed makes them ineligible. It is arguably unfair, but Revenue have considered it and continue to apply the scheme on this basis, and employers must ensure that they do also. This subsidy is taxable at year end, and it is really important, in my opinion, that this is communicated to your employees to the extent that you are utilising this scheme, as it is not a surprise that employees want to receive later in the year that they haven't been told about. Revenue have said that the tax on the subsidy will be collected under self-assessment and will likely be collected over 2021 and 2022 by reducing the tax credits of the individual employees. On the 8th of May, Revenue issued a frequently asked questions document for employees who employers are availing of the TWSS. This is a very useful resource, and I would encourage you as employers to reference it for your employees, as it will address some of their questions or concerns. A real positive from the scheme that also remains unchanged is the very valuable PRSI relief. Any subsidy payment will not be subject to employer PRSI. Additionally, on the top-up payments, employer PRSI will only be payable at half a percent rate, and no employee PRSI is payable. If you look at that by way of example, taking somebody earning a salary of €30,000 per annum, the employer PRSI that would have been paid in 1 month prior to this scheme would have been over €360, whereas now it will be slightly less than €500, so a significant saving. The TWSS is undoubtedly a very valuable relief for employers in this difficult and turbulent time, but it is proving to have complications, and our experience to date indicates that the process is not as simple as you might hope. The TWSS was announced by Government on the 24th of March 2020 and commenced on the 26th of March to run for 12 weeks. The first refunds were issued by Revenue on the 28th of March, and on the 16th of April, employees who previously earned greater than $76,000 per annum but had taken a pay cut of 20% became eligible for the scheme. The operational phase commenced on the 4th of May and applies to submission received on or after that date. In summary, a lot has happened in a very short period of time, but we are now in the occupational phase, and I will now discuss some of the key features of this phase. As I said, the operational phase of the TWSS began on the 4th of May, The key features of this phase are based on revenue's capacity to analyse and provide relevant information to employers, which is a welcome support. However, it also allows revenue to implement the majority of the revised rates which were announced on the 15th of April, which unfortunately makes the operation of the scheme more complex, particularly for employers who are topping up their employees' wages. In particular, the operational phase will see revenue make available a file per employer registered for the TWSS with each employee's average revenue net weekly pay, maximum TWS amount, and maximum employer top-up using a tiered system for the tapering process. This is a very valuable source of information and should be utilised. The amounts of the TWSS will be refunded to employers will be the actual TWSS that the employee received as per the payroll submission, rather than the flat €410 that was refunded per employee in the transitional phase. And the revised calculation rules and TWSS rates will apply. I will consider these rules and rates in more detail later. Employers have a lot on their plate operating the TWSS at a time when capability and resources are likely to be impacted. Revenue's online calculator might provide some assistance to employers struggling with the complexities of the scheme. Prior to processing a payroll, including TWSS, I would recommend that employers should utilise all of these available resources to accurately determine the key data items. These key data items, in my opinion, include, for each individual employee, the calculation of the average revenue net weekly pay, the maximum allowable top-up amounts before tapering, and the maximum TWSS amount. These figures will be the starting point for any decisions on possible top-up payments. Remember, as discussed earlier, the average revenue net weekly pay is based on the January and February payroll submissions, and revenue's confirmation of this amount is now available to you in the file being provided and should always represent the baseline for the TWSS payment. Remember, there are resources available to help you navigate this difficult and complex scheme. The resources that can be utilised to calculate these key data items are the revenue resources, which are now available online. I have used the sample subsidy calculator and I can attest to its usefulness. Your outsourced payroll provider should be able to help. In the event that you operate your payroll in-house, your software payroll provider should be able to provide you reporting functionality that will allow you to utilise the scheme better. And don't forget, a trusted tax advisor who has visibility to your payroll would also be able to provide you with guidance. Even with these supports, the operational phase is likely to be difficult to navigate, particularly if you have a large payroll or have a range of pay levels. So I would recommend that you start early and allow additional time for the processing of your payroll as the TWSS scheme is in operation. So now to consider the rates of subsidy. As discussed, the calculation of the average revenue net weekly pay continues to be driven off actual pay received in the months of January and February 2020. Details of the rates of subsidy as they now exist are set out here across 5 different categories of earners. As a comparison, the transitional phase that ended on the 3rd of May had 3 categories of earners. The operational phase has introduced the up to €412 average net weekly pay category, and with effect from the 16th of April added the previously greater than 960 average net weekly pay category. In the operational phase, the methodology for calculating the permissible employer top-up payment is altered through the introduction of a tiered system and tapering measures. Those in lower incomes will likely see an increase in the subsidy payment, while those earning less than $24,000 per annum now eligible to receive 85% subsidy, while those previously eligible employees on higher wages may actually see a reduction in the subsidy levels being received. This means that more employees will now receive a $350 per week subsidy. Those with an average net weekly pay below $412, as I said, will get a greater subsidy. There's a €350 flat rate for those earning between $412 and $500. While it does not eradicate the problem completely, it should help with the ongoing debate as to whether lower earners might be better off, albeit temporarily, by claiming the separate pandemic unemployment payment. Finally, I would like to consider the tiering and tapering measures that now apply. Tapering of the subsidy will apply to all cases where the gross top-up by the employer and the subsidy exceed the previous average revenue net weekly pay. Revenue have commented that this should ensure that no employee would be better off when availing of the scheme than they would have been before the introduction of the scheme. The single and only exception to this measure is where an employer wishes to pay an employer contribution, which when added to the weekly subsidy for the employee does not exceed €350 per week. In such cases, tapering of the temporary wage subsidy shall not be applied. The operational phase will now apply a tiering approach for employees with an average net weekly pay in excess of €586, which is equivalent to €38,000 gross per annum. Under this tiered approach, the maximum subsidy payable remains at €350 per week, but a new subsidy amount of €205 has also been introduced for those with higher levels of employer top-ups. The tiered approach takes into account both the amount paid by the employer and the level of reduction borne by the employee as set out in the table. The impact is divided into three categories based on the percentage of the gross pay paid by the employer. In practice, the change adds an additional level of complexity for employer. As I discussed earlier, you now need to ensure that you are considering the three key categories. In particular, this will impact employers who wish to fully top up their employees. It is a complex area and needs to be worked through fully for each employee, as the devil is really in the detail on this one. I would like to wrap up this section on the TWSS by saying the wage subsidy scheme was announced by government and rolled out by Revenue very quickly. It is being reviewed and amended by government and Revenue on an ongoing basis. For example, the frequently asked questions document issued by Revenue on the 26th of March is already on its 10th version. Accordingly, it is important that employers keep up to date with these changes so they can ensure they operate the scheme in accordance with the Revenue guidance and legislation. We are here to help and support as required. Next slide, please. Now, let's take a look at some of the other tax considerations that could potentially help you navigate the cash flow challenges being imposed as a result of this crisis. Next slide. Yeah. Interest suspension. It has now been confirmed that the charging of interest on late payments is suspended automatically for SMEs with an annual turnover of less than 3 million, i.e. businesses which are managed by the Revenue's Business Division for May and June POE liabilities and for the May-June VAT liabilities. This is an extension to the previously announced measures which suspended interest payments for February, March, April, May POE and the January, February, March, April VAT. Businesses managed by the Large Cases Division and the Medium Enterprises Division can make a request for interest suspension relating to their liabilities for these periods. Such businesses who are experiencing temporary cash flow or trading difficulties should contact the Collector General's office through My Inquiries or alternatively contact their Revenue contact. It's our experience that Revenue have been practical and amenable to deal with companies in this regard. Please remember that you must continue to file your returns, as again it has been stressed that the importance of continuing to do so. Even where full or partial payment is not immediately possible, tax returns should be filed on a best estimate basis and if you encounter a circumstance where key personnel are unavailable to compute the taxes due because of the COVID-19 crisis, any subsequent amendments can be completed in a self-correction basis without penalty. This then brings me on to the tax debt warehousing. So on the 2nd of May, the government made a very welcome announcement that would bring into legislation to allow Revenue to warehouse deferred VAT and payroll taxes debts associated with the COVID-19 crisis. Pending the enactment of the necessary legislation, Revenue will operate the scheme on an administrative basis. In effect, the amounts deferred from March will be warehoused. Under the scheme, VAT and POE debts deferred while a business is unable to trade or was subject to restricted trading due to COVID-19 related health restrictions, as well as debts for an additional 2 months after the business resumes normal trading, will be ring-fenced by Revenue. Following the announcement by the government, Revenue issued a press release that provided further details of the arrangements, which will have 3 periods, as outlined here. Period 1 is called the COVID restricted trading period. This is the period during which the business was and is unable to trade or was and is trading at a significantly reduced level as a result of the COVID-19. And it also encompasses 2 months after the business recommences normal trading. All relevant returns for the restricted trading phase will need to be filed so the debt can be quantified. And if a best estimate return of liability has been made for any period, the correct return will have to be refiled before the end of this period to ensure the debt benefits from the warehousing. While you're in this period, no interest will apply to those taxes for the period, and debt enforcement has been suspended. As you will expect, it is understood that the period and the months that will apply to this period will vary from sector to sector and business to business, depending on when the government restrictions are relaxed. Period 2 is called the zero interest phase. It will begin 2 months after the resumption of normal trading, and the outstanding VAT and PRE tax debts will be warehoused for 12 months, during which there will be no collection of this debt by revenue and no interest will be charged. However, it is important to note businesses will be expected to pay current liabilities as they arise during that 12-month period. Period 3, called the reduced interest phase, will begin at the end of the warehouse 12-month period. In this phase, a reduced interest rate of 3% will apply on the repayment of such warehouse tax debt until it is fully repaid. It has been confirmed that tax clearances will not be affected by this, and Revenue have confirmed that the time frame allowed to pay the warehouse debt will be flexible and determined with the ability of the business to repay the COVID-19 related debts. Further arrangements and full details will be published in due course. Finally, I would like to bring your attention to some practical steps that you and your business could take to ease cash flow burdens at this time. I'm conscious of time restrictions, so I will go through these quite quickly. Firstly, if you know you're due a refund, we'd recommend that you file your return early, as you will secure your refund. And it's important to note that while you may have filed the return early, even where you have a liability payment, it will not be due until the deadline for submission anyway. As a reminder, Revenue has stated they will advance any payments of instalments of excess R&D tax credits for 2020. This will not happen automatically, so if you have a company that falls into this area, we would recommend that you engage with Revenue to secure this early repayment. Preliminary tax and the payment of preliminary tax is something that is topical at the moment. It arises for both individuals who are chargeable persons and companies. When calculating the preliminary tax payment to be made, for the most part, it is based on your prior year liabilities. I suggest that this year it could be advisable to utilise the option for paying your preliminary tax based on your current year liabilities rather than your prior year. While this option is always available, it is rarely used as it is a more time-consuming calculation. However, given the current situation and the drop in income levels being experienced, it could prove to be a significant cash flow advantage. Therefore, I would recommend that you consider your preliminary tax payment early so that you have time to utilise this payment option. Sole traders, corporates and partnerships could consider changing their accounting year end. The rationale behind this is that it would capture poor trading results. For tax purposes, there's no impact on the tax payment or filing deadlines, but the assessable profits will be calculated based on the 12 months proportioned profits. And VAT is another area that I would recommend as a company. You might just consider your VAT profile and what your VAT profile looks like as a result of this crisis. And there is options that you could use, such as considering the timing of your invoices. Is there availability to move to a money received basis? Are you ensuring that you are reclaiming VAT where you've applied discounts or encountered bad debts? And remember, there's a 4-year look back period where you could look back and identify VAT that hasn't previously been claimed. This is an area that I just wanted to touch on quickly. While the biggest focus for business in recent times has been on navigating the crisis and trying to ensure survival, an area that is getting more attention and that we're starting to see clients looking to focus upon is the area of succession planning and asset transfer. There's likely to be a few factors driving this interest. Firstly, there has been a persistent rumour for a number of years, which is now getting stronger, that we will see a reduction in business property relief. This could see a drop from 90% relief that currently exists to 85% or even lower. Asset values are likely impacted at the moment as a result of the crisis. Therefore, the tax consequences of completing transfers will also be lower. And finally, capital acquisitions thresholds are at the highest level they've been since December 2010. While we don't know what changes will be introduced by the government, there is indication that they do not want to increase income tax rates or VAT rates. And given that the funding for the crisis will need to come from somewhere, it is reasonable to expect that we could see some capital relief cuts. As such, I would encourage anybody who's thinking that they would like to consider their succession plans in the near future, that it might be worth taking an initial look now and seeing if you can utilise some of the relief currently available. For today's session, I just wanted to mention it as an area to be considered, but perhaps if it's of interest, we could run a more in-depth session on this topic in the future. That leads me to the end of my presentation, but I'm happy to take any further questions.
Yeah, thank you so much, Aileen. That was absolutely fantastic. There's a lot in that TWSS and a lot of considerations, particularly around the cash flow savings that can be made to firms if they start looking at and all those tax issues that you've mentioned. And obviously your advice is to talk to your tax advisor for some in-depth look at your operation.
Absolutely. Your tax advisor should be your first port of call. They're there to help.
Very good. John, if you're still on the call, we'll just have a couple of brief questions because I'm conscious of time and we'll need to finish up in the next couple of minutes. So somebody here is asking about applying to the bank and that they're going directly themselves, but they're finding it difficult. So this is down to your point of view about appealing. So there is an appeals process if you are rejected.
Yes.
So you might just walk through
there
that
is,
again.
And the link to the appeals process. Yeah, okay. Well, each bank has its own appeals process, but actually the credit review office will, free of charge, there's a helpline for the credit review office on their website, and they will actually help you to do the appeal with the bank, even before it has to go to the credit review office, and there's no charge for that. So, but each bank has an appeals process. There's a link on their website. And basically you literally just appeal it. It means that your loan application is viewed by a different credit underwriter or a different team, and it's reassessed. And as I say, there's a 1 in 4 chance at the moment that that decision could be overturned based on somebody else looking at it for you.
So if you've done a good business case, you still have a good chance of getting that loan if you go through that process. Excellent. The second one is talking about funding via LEOs. Are there cash grants from LEOs? I think LEOs give you support, but Microfinance Ireland might be the other route there.
There's a couple of grants I think that the local enterprise office are able to do. They're the online one, the online voucher one, which helps your business go online. There's also free mentoring available from the LEOs, but the microfinance offer loans, but there's a 6-month moratorium on the payment from those. And those loans are effectively unsecured, and they're up to 50,000.
Yes, they've increased the limit on those from 25 to 50.
They have, yeah. And actually, they've dropped the rate. The rate used to be 7.5. It's now down to 4.5.
Excellent, with a moratorium on payment for the first few months. So that's well worth exploring. And I think your Leo in the first instance is a good place to go because the mentoring will help you get the business plan together for your Microfinance Ireland application. Excellent. Aileen, a quick question here. It's obviously somebody who's a property owner and they have their tenants have cash flow problems. Should they be looking at, what should they be looking at from a tax point of view?
So probably one of the things is around the preliminary tax that we touched on earlier on. Maybe if they're looking at preliminary tax payments coming up, they could look at a position where they base it on their estimated current year income rather than a prior year income. And then it's probably around managing, again, VAT might come into this. They might need to look at what their current VAT profile is. So there is tax things that they could do to ease cash flow.
I think a little more information is needed, and probably go and talk to your tax advisor.
Absolutely.
Very good. Guys, thank you so much. We've run out of time. What I'm just going to say is all the resources are on the website. The SBCI site has got a lot of information there. Smith & Williamson have got a lot of information about the TWSS, and there's a number of resources on the Sandyford Business District website. We'll be pushing this up on the website as well, so you'll be able to look back at this and see the slides again. My thanks to Aileen Dunning of, yes, John?
Sorry, there was one question there just on the Q&A that asked, qualify as an SME or mid-cap for working capital loan or companies precluded by virtue of partnership enterprise rules, which apply to entities that control more than 25% of a company. The answer is they are impacted, but they may still qualify if they still fit within the definition of the SME with 250 employees and the turnover of 50 million and balance sheet of 43. And there's a user guide for the SME definition available on the European Commission which is actually really informative on that one.
Excellent. Thank you, John, for picking that one up.
Sorry about that. Yeah.
Much appreciated. There's no problem at all. My thanks to Aileen Dunning of Smith & Williamson and John Madigan of SBCI. Please follow our LinkedIn and Twitter pages, the Sandyford LinkedIn and Twitter pages, and for more on our series of webinars, which we're holding each week. And thank you so much for joining us today. And from everyone at Sandyford Business District, keep safe.
Thanks, Mark. Take care.
Take care. Bye-bye.